welcome to the third quarter capital market review. This capital market review is a little bit different. It's pre-recorded. I'm about to leave for Argentina for just a little over a week, but I wanted to get this out this month and as close to the end of the quarter as possible. It will work different. As in the past, we always had some questions, and I was here live to answer those questions. Once you get this, if you have any questions at all, kindly send those in to Danielle. She'll relay those to me. We'll answer them and get those right back to you in email form ASAP. With that in mind, let's continue. We always come up with some kind of a theme for each of these recordings, and I think this is appropriate. I decided to title this About Growth and Its Consequences. And what I mean by that is since the first quarter of the year, we have seen pretty decent GDP growth. It's kind of interesting because preliminary numbers for the third quarter came out, and it looks like about 3.5% growth, pretty robust. And the concern with respect to that is, you know, if the economy picks up and we get this kind of growth, is it not only sustainable, but what does it mean to other aspects of the investment community? Interest rates, PE ratios, the U.S. dollar. We're going to touch on some of those as well. People ask why we do this. We do this because we feel the economy matters. We're very much top-down. The Federal Reserve is omnipotent, and if they want to slow or speed the economy, they will through policy. And if we have a general sense for where they are and where the economy is, that does most of the heavy lifting with respect to the portfolios. So it's important to dissect periodically the economy and look at growth and jobs, what profits look like with corporations, where are we with respect to inflation or potentially deflation, and where are we also with respect to interest rates and potential movements up or down with those said rates. What we try to do is answer just simply, hey, where are we right now? And more importantly, where are we heading? If we can get that mostly right, we'll all do really well. By also providing this, I think it gives my clients the ability to kind of stay a bit more focused, stay a bit more balanced, and more importantly, stay invested. We don't want to have that feast and famine roller coaster ride where we're risk on, risk off, in the market, out of the market. Over time, that really just doesn't work very well. The 5 themes for this quarter are also new. We want to talk a little bit about the pickup in U.S. growth and whether or not it is sustainable. We want to talk about interest rates and the impact on the economy, both in terms of fixed income investments, bonds and bond funds, as well as other investments, commodities, equities, so on. We also want to talk a bit about the significance of the rising U.S. dollar. If you've been watching, you might notice that the U.S. dollar has been rising a bit this last quarter in particular. Very strong growth, and that over time will have a bearing on U.S. profitability as well as profitability for foreign-based companies. And with the U.S. market at near highs, we had nearly that long-awaited, much-anticipated 10 to 12% pullback. It was really about 9.3%, and we bounced back very quickly from that. Are U.S. equities still all right? Is there still value? Should we not only own them, but more importantly, should we be buying them right now? We'll talk a little bit about that. And the last point I threw in, just some random thoughts that hopefully will get us up and through the end of the year and into the first quarter. So where are we? Here, we really want to just focus on, you know, what's happened since the last time we chatted. Well, you can see that the market actually increased here a little bit. We certainly have more growth since the last time we spoke. In fact, from the very bottom, the S&P 500 is up about 192%. It has more than doubled and nearly doubled again. And we'll talk a bit more about valuations in another slide, so I won't spend an awful lot of time here. But we're now at a point where we have surpassed the previous highs and have done that by about 20 or 30%. So we've gotten some pretty good growth, actually about 32% above the previous high nearly 7 years ago. Returns for the quarter were really pretty robust. But you'll see that there's a divergence. If we look at the third quarter's numbers here and just walk across, you'll see industrials, the energy sector, especially oil, was down significantly. A number of sectors like consumer discretionary and materials were nearly flat. The S&P was only up 1% for the quarter. Most of the return for the S&P came in the early part of the year. And since we now are almost a month into this last quarter, I can certainly say that as of early last week, most markets were flat on the year, in part because of the little bit of sell-off that we had. The big winners for the quarter would have been things such as technology and healthcare. Financials did well, as did telecom. And all of those were a multiple of the return of the S&P during the same period of time. Let's talk for a minute about interest rates and inflation. As you can see from the chart, interest rates are hovering near their all-time low. And in fact, they've been falling now for about 33 years since the peak in 1981. Nominal rate, that is the 10-year yield, as of September, was 2.52. I think it's about 2.35 today. Inflation's hovering about 1.7. That's this number right here. And as a result, you subtract this from this, and you get the nominal yield, or real yield rather, what you actually make is just barely above 1%. The expectation is at some point here, interest rates are going to kind of start this trend higher, as it did through most of this period of time here. Let's get started. Let's talk about the economy and whether this economic growth that we've seen lately is sustainable. One thing you'll notice is in terms of real GDP, for this last quarter, GDP has actually increased about 4.6%. That's in the second quarter of the year. Now that's coming off of a negative 2.3%. So actually, year to date, that's through the second quarter, we were at about 2.6. We'll probably finish the year 3, maybe a little above or a little bit below. So we're really right about at average right now in terms of long-term growth. The expansion has been anemic, but actually the growth rate now, the long-term average, is pretty much right in line with where we've been. Another interesting thing is, where is growth going to come from going forward? Well, government spending probably will drop. We'll probably see less spending from the government. We're just not using TARP. We're not using quantitative easing. There will be less things that the government will do. Consumer consumption will probably increase. And at some point, this is really the big question mark, is what happens on the investment side of the house. What happens to tooling and plants and equipment? The thought is, because of capacity and in particular productivity issues, we are probably going to need to see that increase as well over a period of time. We think the growth that we've seen is sustainable, and we think it's sustainable for a couple of reasons. Let's look at light vehicles or trucks. We are just now above the trend line, and that was a long time coming. We've also seen great growth in auto. In fact, the third quarter's auto sales numbers are the best that we've seen since the first quarter of 2006. Housing starts are still below trend, and that's important because there's quite a ways to go. And with housing, the issue really is much less to do with affordability. It really has to do with mortgage availability. So that could really improve. And when you see housing starts improve, there's a multiple effect. Its impact on skilled trades and truck sales and tool sales and all of that. The one chart here that's a bit anemic, and frankly we should see some improvement at some point, is this one right here. And what we're referring to here is actually the manufacturing and trade inventory. We should see at some point an improvement there, because at some point we should see an improvement in capital spending. To date, we are still not at the levels we were in 2007 or in 2000. Companies have been holding back as long as they can from the standpoint of going out and spending money on plants and equipment to improve forward-looking productivity. At some point, that's going to have to change. The unemployment number is actually right now, with the beauty of hindsight, is 5.9%. The number that we're showing here, 6.1 as of August. We know as of September, it actually dropped to 5.9. So right now, we are just below the average. So we actually have more employment than long-term average. And you can see that we've gotten back in terms of jobs gained every bit of the jobs that were lost during the Great Recession. So that's also a positive. Let's look at the labor market and some of the forces that impact the labor market. First, average hourly earnings or wage rates are improving substantially. That's important because that will drive consumer spending and such. It also drives investor confidence. This is a bit problematic. The labor participation rates have been dropping significantly. There just are much fewer folks in the workforce, and that has an impact on economic growth. Now, some of that may very well be structural, and it'll be hard to fix in the short term. By structural, what I'm referring to is we just have a ton of baby boomers that are retiring out, and we don't have a lot of Gen Xers filling in those same positions right now. The other thing, and this is kind of interesting, I can't say it's true or not, but it was at least thought-provoking, is I read an article written by a professor who suggested that another reason that the labor participation rate is dropping is as employers, we've gotten much, much better with background checks, and as such, we're purging from the workforce an awful lot of folks that have felony convictions, MIPs, and other issues that normally would have gone unnoticed. And as a result, the workforce is becoming very selective. As far as the long-term economic drivers, those things that actually impact the market and the growth rates over extended periods of time, let's just look at this here. When you talk about economic growth and you say the economy is growing at 3%, essentially, that came from about half of the growth came from the employment pot increasing at 1.5% a year, and it also came from real output or productivity increasing as well over the period of time. Now, that being said, we see much less of that today. That's the 50-year average. Look at more recent times, the 5-year average. The employment number is dropping and dropping pretty significantly, and the real output per worker has been the main driver. Unless we see an improvement, and we can improve one or the other, it may bode well for better margins today, better growth, but it could be a negative impact on forward growth at some point in time, especially if we don't see an improvement in plant and equipment and capital expenditures. Let's look at interest rates. We saw this chart just a moment ago. When I look at this, I feel as if, look, interest rates can't go anywhere but up. Rates are extremely low today, both on a nominal as well as a real basis, and the likelihood is that they will trend higher here at some point. When that happens, it has an impact on corporate profits. To some degree, rates become a greater expense, higher interest rates, and it also has some impact on bonds in general, and we'll address that. Other people are concerned about, will rising rates have an immediate impact on the economy, or an immediate impact on housing, or an immediate impact on the market, and I just don't believe that will be the case. When you look at this chart, let's look at this bottom quadrant. And this is of some concern. The Fed announced yesterday that they're done with quantitative easing. The market is actually rallying because it's perceived they're done because the economy is healthy, but they stand ready to provide quantitative easing part 4 if need be. I believe the GDP numbers are right on point. This is in line with many other universities and many other econometric research shops. The unemployment rate number, I think, is a bit behind the curve. Currently, the unemployment rate is actually below 6, and if we expect the economy to grow at 3% a year, one would expect over the next 2 years that the unemployment rate would come down at something quicker than 0.7%, which is what they're showing here, from 6 to 5.3 over a 2-year period, or 0.9 over a 3-year period. We think it comes down much quicker than that. As a result, they factored in that they expect interest rates to slowly move up this year from where we are today to about 1.38 and then 2.88 and beyond. It may very well be that they'll need to raise rates a bit quicker than that, and that could be a little problematic for the market, as we'll see. Right now, the market's done great, and it's done great because of cheap money, low interest rates. This is interesting. If inflation is under 2 and the Fed's going to start raising rates from a quarter point at a time, it could be well beyond 2015 before interest rates are actually above the inflation rate. And if that's the case, then it appears that the nominal rate, while it's going up, still doesn't allow the real rate to be above a plus number or positive net of inflation. At 1.38, this number here, with 2% inflation, we're still losing purchasing power. So effectively, these are still real cheap rates and shouldn't have much of an impact on the market, consumer confidence, or spending. Bonds, however, are a different story. This chart shows the light blue number is year-to-date. The dark gray number is 2013. And just for a refresher, in 2013, interest rates actually rose. And year-to-date, they've fallen because of the really weak economic print number in the first quarter of the year. Let's look at the impact of interest rates as they're rising. That would be the 2013 number against bonds. Anything this side of this line is negative, and you can see treasuries were down significantly, about down 20%, and you can see 10-year bonds were down about 8 or 9%. That's the interest rate, base rate movement. The coupon was 2 in this case, and the 30-year got to 2.6. So when you look at total return, the return on 10-year and 30-year treasuries were really negative. The return on floating rate was positive. The return on high yield was positive. The return on emerging market debt was somewhat less problematic. So if we're going to stay in bonds, the idea is to shift from traditional treasuries or aggregate bond index to floating rate and other bonds that are somewhat less sensitive to the rising interest rate environment. Consumers should continue to spend in spite of rising rates for a couple of reasons. One, the household debt service ratio is as low as it's ever been, meaning consumers need a whole lot less income to cover their debt expenses. Also, household net worth has exploded over the last couple of years as the markets have all come back somewhat, and that also is positive. So both of those should lend itself to strong consumer confidence, should also lend itself to strong spending. On a national basis, assets to liability is a ratio of about 6-to-1. A lot more assets than liabilities, so that's a huge positive. If you look at home prices, you'll see that they're kind of close to historic index. But if you look at, as an example, home inventories, the amount of homes available for sale, they are much less than benchmark rate. And the issue here is much less to do with price, but has more to do with the fact that there are very few loans available out there for lending. The affordability index is very cheap. Homes are very inexpensive relative to income and debt levels. And the interesting thing is interest rates would have to increase 50% from where they are today. If a prevailing mortgage is 4, it would have to go to 6. If a prevailing mortgage is 3, it would have to go to 4.5 before it would have any impact on affordability, before the affordability rate would be trend line. So that's a lot of movement in rate before things just become average once again. Let me share with you one thing about credit conditions, and that's right here. Look at what the lending standard is for approved mortgages right now. The average FICO score, 743. It was about 7 in 2006 or 7. I'm not suggesting it go back there, but the average rate is extremely high. The reason? Banks do not want to lend money. They're being very selective as to who they lend money to. It's a very, very tight, very controlled market. And one of the reasons for that is with the low interest rates, banks just do not want to lend money out 30 years. If interest rates start to rise, and they could because of the fact that quantitative easing is over, then we may very well see banks get interested in lending again. That could spur a resurgence in home starts. It also appears that rising interest rates really shouldn't have much of an impact on the budget. You know, we're eliminating some borrowing here. And more importantly, when you start looking at the budget surplus or deficit or federal net debt, it kind of is flatlining here for several years going out to 2024. Now, obviously, if growth is better than expected, we'll be able to pay down some of that debt. If the economy continues to grow and the debt levels stay relatively flat, then debt levels relative to the economy become cheaper and cheaper, and the debt levels become more and more manageable. This is a bit confusing. This is Treasury yield versus weekly return, rolling weekly numbers for the S&P. The only thing you need to know on this chart is right here. And what this is saying is effectively when yields are below 5%, and we're talking about 10-year yields, and right now it's 2.35. When they are, or actually 2.31, when the yields are below 5, rising rates are generally associated with a rising stock market or rising stock prices. Reason? They're rising because the economy is healthy, and a healthy economy drives greater profits and drives lower PEs and provides more wiggle room for growth. Over 5%, they start to become a headwind, so we really don't see that anytime real soon. Let's talk about the U.S. dollar. You know, for the longest time, everybody complained that the dollar was falling. We had a weak dollar policy. A weak dollar really helped U.S. companies sell a lot of U.S. goods and helped somewhat with the muted recovery that we had. And the dollar here has really started to increase relative to other currencies. You can see that kind of right here where I'm trying to use this marker. The dollar clearly is strengthening relative to other currencies. A strong dollar is kind of negative in the short term for foreign investments. Because when you take the return there and translate it back here, you tend to lose money. As an example, the third quarter of the year, the EFI exchange was up 1%. But when you translated that back into the U.S., it was actually down 5.8. So as a U.S. investor in international, we actually saw a drop in value. Very early in the quarter, we actually started to reduce our international exposure by reducing some of our European exposure. We like Europe over the long term. We think growth is actually better in Europe at some point going forward. But right now, with the dollar rising as it is, very difficult. Just about every single one, by the time you add back the currency effect, you're losing money in U.S. denominated dollars. So that's a problem. Look at Germany. That problem, though, is somewhat temporary. Inflation is really pretty benign. The 50-year average is close to 4.1%. We're at 1.7%. And the other thing is inflation, while it's not a problem now, may not be a problem in the near foreseeable future. Because when you get to core, you're factoring out energy. But energy is actually could very well be dropping with the fracking and newfound oil reserves. That could put a cap on oil cost, energy cost, and that could really, really help. It becomes almost a de facto tax cut, and that could keep rates down somewhat. What could hurt this is just simply the Fed puts a blind eye on the fact that the employment rate's improving and it's beyond their factor. They're caught behind the 8 ball. They've got to raise rates a bit. We start to get companies competing for workers because of the shortage of workers and the need to improve productivity. So also you start getting a wage-based inflation spiral, and that could cause the Fed to take action and actually raise rates. When you look at this heat chart, green is good, red is bad, and as you can see through September, we're mostly green, and we've been pretty green for the last several quarters. Clearly in 2012 over here and beyond, a lot of countries were still red. What we're going to see at some point with the U.S. dollar rising, we'll see economic activity slow down a bit here. You can see from 57.9 to 57.5, and at some point it'll pick up in Europe. And part of it is we're at max capacity, and what we're probably going to end up doing, since we're capacity constrained, is send some of the capacity to Europe, especially if their dollars relative to their currency are cheaper because our U.S. dollar is too strong. I like Europe and the international markets over time. When you look at PEs in U.S. and emerging markets and Europe, they're much cheaper than we are. In fact, they're quite a bit going forward. Now, if you look at Europe relative to our emerging markets, down a bit, Europe down quite a bit compared to the U.S., you certainly see that the U.S. has outperformed and has done so really coming out 2009. At some point that will shift, and we're watching that fairly closely. Let's finish up with the U.S. Corporate earnings are great. Operating earnings are just off the chart and continue to be. Companies are making quite a bit of money. They're working workers harder. They're not spending a lot of money on plants and equipment and new tooling. All the productivity is coming from, to a large degree, the work population and hiring folks to fill the machines that were left idle. Profit margins are strong, and the total amount of leverage being used is very low. So this isn't as if earnings are being ginned up because of a high degree of debt being used. Really, it's not that at all. These earnings are great operational earnings. They're unlevered. The amount of leverage that's being used is very, very low. So that tells me that if there was a need to expand and they needed to borrow to expand and leverage their balance sheets, there could be quite a bit more growth as a result of that. The quality of those earnings are a bit less, but still growth nonetheless. Valuations, it's probably very fully valued. I'm not saying it's cheap at all, but I'm not saying it's overpriced either. The real issue is what happens to the economy. Right now, PEs are about where they've been in the past. If you compared the 25-year, if you compare the 10-year, or where we were just a year ago, they're a full point higher. I'll have some comments on this a bit later. If you look at dividend yield, it's just a little bit less. You look at real earnings, they're actually better than they were 25 years ago, still better than they were 10 years ago. And price to book is equivalent, and the yield, the EY, the earnings spread, is actually still better than it was 10 or 25 years ago. So if you look at this from price and valuation, it might be a bit expensive. If you look at it from earnings yield, it's still less than fully valued. Still a little bit of a bargain. And you can see that here, where the bond yield and the reverse earnings yield, the inverse yield is still higher than bond yields. When that happens, there's some wiggle room, and one could say that the market isn't ridiculously overpriced. A couple things. If the economy continues to grow, if corporate earnings continue to improve, then the PEs actually come down and the market looks cheaper once again. Let's look at the equity performance in bull markets, or more importantly, what do things look like now relative to other bull markets? And we can kind of see this here from the start of bull markets. Here we are in 2009. This is us. We're up 192%. And this is returns before market passes average valuation. We are at average valuation. We're not any better. In the 2002 market recovery after the dot-coms got to average valuation and then petered out. That would have been 2007. In 1990, the markets ran 180%, got to full valuation, 17, 15 times earnings, and then ran an additional 83%. Here, 49, 30, 16. So there's still a fair amount of room to run. As an example, 2002 to 2007, 85% of stocks got to within 5% of all-time high. We're now at about 78%. If you look at new highs, 11% of companies got to new highs. We're at about 16%. So the market is at the point where It's all going to be left to the economy and whether we can see an improvement in earnings. The only thing I want to share with you here is there's a lot of cash on the sidelines. We've got $11 trillion of cash sitting on the sidelines earning nothing. If earnings start to improve, there's going to be piling in. When cash isn't earning anything, you generally have to get it invested somewhere. So I think that's also one of the reasons that every sell-off we've had in the market has been met with a lot of buying. And that could continue for a while. We've got a boatload of cash, and a lot of it sitting in money market funds and savings deposits. If you look at asset class returns for the quarter, you can certainly see the quarter was difficult. The S&P was up 1%. That's all stock. Bonds were flat. Cash was flat. And then everything else was generally negative on the quarter. Asset allocation funds, because they had a bond exposure, were negative. Real estate was down. Emerging markets was down. Europe, Asia, Far East index was down. The Russell 2000 small cap was down almost 7% for the quarter. Commodities were down 11%. That had everything to do with the strong dollar. And if you look at year to date, you'll see a little bit different. REITs were up quite a bit. S&P was up 8%. Barclays Ag made 4%. But a lot of those returns are coming in a bit because of strong dollar and valuations. A couple of random thoughts. First, where are we in this economic cycle? I think we're right here. Where were we? Including somewhat last year, we were here. Everybody was kind of worried about the wall of worry. What happens in a case like that is you get earnings growth, real earnings growth, but the multiplier, the PE, expands. And we saw that when we look at the PE this year versus last year or this year versus 20 years ago. It's expanded. It's quite a bit more now than it was 4 or 5 years ago. So with the multiplier expanding, prices go up significantly. We're now crossing over to this other phase. And here, earnings kick in. Corporate earnings really start to be noticed. PEs actually can drop here a bit because as earnings go up, the P over E, the E goes up, the P over E goes down, and the market continues to improve, not at the same rate. Effectively, stocks become a bit cheaper in this phase. And then, before everything ends, you get optimism. And everybody's buying everything. And what happens is earnings continue to grow at a slower pace. PEs expand again. I mean, they take the PE up to and above current levels, and as a result, you get a huge increase in price before this party's over. So that's kind of where we think we are, and I want to thank Goldman Sachs for that particular slide. Goldman Sachs, they're also forecasting S&P valuations. A point on that, they think the S&P, which is at, I think, 19 and some change, could be at 2050 by the end of the year, and then by the end of next year, 21, and then 2200. The trend's going up, but the trend is also going up at a slower pace. And actually, if you look at the difference between this and this, it's 50 on a basis of 2,000. What is that, about a 2 or so percent, 2.5% growth rate? So growth rates are dumbing down. That's S&P. That's one of the reasons that foreign, emerging markets, other asset classes may look a bit more attractive. Alternative asset classes may look attractive. We talked about the numbers in the last quarter, how most were slightly negative. Look at the alternative class. MLPs were up 2.7, global macro up 2, the high yield foreign aggregate index was up 2.1, merger arbitrage up 1. These assets don't look like stocks, they don't look like bonds. They're a separate asset class that can drive returns independently. And it may very well be, if returns dumb down, we'll need to expose ourselves to more alternatives. In the past, alternatives were always real estate, energy, commodities. We run our global macro portfolio, multi-asset, globally diversified, using some of these in the mix in our balanced account. In the future, we may actually see more alternatives with the use of managed futures, long-short equities, global macro, etc. Those things, like unconstrained bond or multi-asset, multi-authority, or long-short can actually improve the return. When we add alternatives to a traditional account, standard deviation tends to drop, and returns can actually lift here a bit. Now these are actually, this is a return spectrum, actually historic, from 1990 right up through 2014. And you can see, even though the market did well during that period of time, many of the alternatives actually improved upon the U.S. stock market return or international or commodities. So we're doing a lot of work right now in the alternative space. Well, we already had this near 10% pullback, although arguably it was not 10, it was a bit less. And I always close or wrap up by saying, hey, volatility is part of the business. The gray bars show the S&P 500 in any one given year, and the dot underneath would measure the inter-year drawdown. At some point during the year, the market dropped from some peak to some lower point before regaining. Without spending a lot of time on this, you'll also see, in many cases, a big drop. Here's an 8% drop or a 10% drop. Does not in any way indicate that the return for the year will be negative. In many cases, a 10% drop yielded a 13% return, or a 7% drop yielded a 17% return. There's very little correlation. We try to avoid big drops in value. We use stop limit orders on some of the investments and so on, but having a portfolio with no volatility is also a portfolio with no return. Last thing before we close is seasonality. Hey, next month, or I should say this weekend, marks November 1st. November 1st through April 30th is typically the best 6 months for the market. So I'm not saying that we are done with volatility before the end of the year, but there are an awful lot of hedge fund managers, awful lot of managers who really underperformed this year, and there may very well be some kind of rally going into the end of the year, and we certainly expect to participate in some of that. So with that, let me know if there are any questions. I'm sorry I can't be with you live. I will try to be with you live next quarter. Also want to remind you of our second opinion. If you know anybody who is concerned about what they're doing, concerned with how their portfolio is structured, concerned with anything related to finance, please give us a call or have them give us a call. We'd love to sit down and see if we may be able to help them, or at least give them a better understanding of what they actually have and how it's working. With that in mind, I'd like to welcome you and invite you to our disclosures risk page. These are all the definitions of all the slides that we saw. We're just kind of wrapping this up. If you have any questions about anything, please let us know. I might not talk to you before the holidays. Have a wonderful Christmas. Happy New Year. Thank you very much. You are all very important to myself and my family. If we can do anything, please let us know. Thank you.